Now we want to turn to inflation in a different way and look at some of the price increases that we've seen or that are expected to be seen in housing, and then just other parts of the U.S. supply chain in general, as we talked about with trucking. We see the same thing just in other areas, but what is the driver? And that's when we start turning to inventories and that being supportive of additional price increases. So when we look at the new high in U.S. expected, so this is what people expect, is another increase in their through 2021 of their homes. So over the next year, do you think that the average price of houses in your area will increase, stay the same, or decrease? 71% are now, or back to the above 2005 levels, believe that their home prices will be increasing. And housing starts reverting back to pre-COVID trends. So we did get a slowdown in new homes, but there's the ones that have permits have increased, but we're just seeing less people breaking ground, and it could be, there's a lot of costs and those costs continue to go up, which again is kind of putting people in a tough spot and maybe delaying or trying to slow down some of the breaking ground to try to allow for some of the prices to normalize, because there's only so much that the developer can really pass through, and they're trying to wait for some of these adjustments, which is why they're coming closer to the pre-trend level. So then when we look at cumulative evictions, as we talked about with the eviction levels before in the second in the end of the first segment, it's important to look at, well, as the evictions accelerate and you get back to closer towards the historical average, you're going to put more assets on the market. That's going to help try to alleviate some of the pressure in terms of just supply, which again will be a little bit of a headwind for some of these prices, which again will help normalize the market a bit and kind of pull some of that down in terms of the inflation in the housing side. But expected home price change, this is looking at it from a different perspective because this is the median. So the expected home price change, you're by how much, and people are expecting about 5.5% increase. So 71% think their home will increase in value, and it's going to increase by 5.5%. But where are we seeing the increases? So the U.S. home price, which again coming back to the difference between the haves and have-nots, the rich versus poor, the U.S. home price growth over the past 3 years by price tier, you're seeing the increase in price at the lowest level. And I mean, given Long Island is its own conundrum in its own right, but you're seeing homes that are getting purchased for $400,000 to $600,000, and then they're getting torn down, repaired, put back up at 1.1, 1.2. And you're seeing that happen over and over again, where you're getting developers coming in, trying to buy things at the lowest level and then repairing them and then trying to flip them at the $200,000 to $300,000 level. So you're starting to see a lot of this movement, but there's also a lot less supply as we showed, the average median home price is now $350,000. So there's not a lot of supply at that bottom. So as you start to see the competition accelerate, that's why we're seeing those prices really pivot higher from cheapest, middle to most expensive as that continues to accelerate to the upside. Now, with all of that being said, let's look at manufacturing prices paid. So this is the New York Fed. So the New York Fed prices paid went up 83.5. And then 6-month expectations, it's come down, but again, it's still well above the highs and back at the levels from 2007. Now, it doesn't mean it has to stay there. No, people can expect them to continue to come down. But just based on the delays in the system, the delays in the supply chain, the expense that continues to come in, it's unlikely that we're going to see these prices continue to roll. Now, prices received. So prices paid at 83.5, current conditions on the prices received at 37.1. So even though prices, they expect prices to come down at the manufacturing level on the prices paid, they expect prices received to go up on the 6-month expectation. And that's why we've talked about this, where even if you get a bit more normalcy or at least a reduction in commodity prices, not all of the prices that you've paid have been recovered, which is why you can see prices paid come down much faster than prices received. And again, the vice versa on the way up, which is why when we look at the price increases in the system, we've yet to see the full realization. And that's why I think on the consumer level, we're going to continue to see this grind higher, just keep giving some of that support to those underlying inflation levels. So then when we look at the number of employees still remaining very low, with the idea that over the next 6 months, you're going to get a bigger ramp up. But even as you hire more employees, the average work week is expected to come down. So when you look at where it is today and where it is going forward, and this is when we start talking about, is it full-time work? Is it part-time work? Which, again, trying to manage some of these labor costs, which is going to, again, trying to limit some of the labor costs, which is going to limit wages, which is going to limit spending, which is going to, you're starting to see where I'm going with this on a constant level, not to be repetitive, but those pressures that will remain. Then when we look at the Empire State Manufacturing unfilled orders, back to, and just looking at the chart at the all-time high, which goes back to 2005, and then in U.S. Empire State Manufacturing new orders still remaining elevated. So you have unfilled orders on top of new orders, but you just can't get the stuff. Like you need inventory to make to fill these orders. So as these unfilled orders continue to mount, you're going to try to get goods as quickly as possible anyway, in any shape, way, and form, which is why when we look at inventory to sales ratio going back to 2002, you can see this massive drop in inventories and total business inventories to sales. Again, all of them are at all-time lows. So you have inventories at all-time lows. You have a near record amount of unfilled orders, a near high of new orders. So your whole supply chain, you're going to do what you can to try to bring in product as quickly as possible, paying a price that may be a bit exuberant to try to get people involved, to try to get people coming through. And again, these are things that are just going to keep pricing elevated at the manufacturing level to the consumer in general. So then when we look at the Empire State prices paid and PPI core goods, this is again showing that pull up and that driving higher. Not to say that it's going to it's going to continue to drive up. The question is stagflation. When we start to see some of this normalcy, because used cars was a huge driver in this recent inflation increase. Now, I think obviously that'll pare back, but there will be some support in other areas. Like food didn't see that kind of the same type of increase, because when you look at the futures market in terms of where grains are, that's only that, again, the futures market. So we're going to see that get pulled through, and that's going to continue. Then you look at gasoline prices. All of these things are going to continue to be some of these driving factors on activity. So then when we look at crude oil, core PPI, you're just seeing that inherent push higher. Now, even though crude oil on a percentage level has started to come down, when you look at year over year, you're still seeing the core PPI hasn't even started to track it higher. Not to say that it will, but it'll be a support, and especially when you start looking at diesel and gasoline on a lot of these pressure levels as more price tries to get passed through in general. And then when we look at U.S. PPI final demand, when you look at the final demand side month over month, it came down off the highs, but it was still positive. So you're still having more price coming through. It's just less price. So it's not that it's now negative and you're seeing price come out. No, it's still positive. And when not talking, and then when you look at less food, so when you start taking out food and energy, because food was actually down. When you look at take out food and energy, you were actually at 0.7. So you were flat. So you still have a continuous price coming through at the producer level, which is why, looking at this a little bit differently when you want to look at on the inflation side. So April PPI inflation higher than expected at 6.2% year over year, 0.6% month over month versus the estimate of 5.8. Now, the prior peak of 4.5% in 2011 was obviously easily taken out, and core PPI was 4.1% year over year, or 0.7% month over month, versus 3.8% on the estimate. So again, driving higher when you see the inflation side taking out those highs, putting additional pressure throughout the system. Now, when you look at the percentage of S&P 500 companies citing inflation in Q1, they're not saying this as a fear, like we fear this is going to happen. They know their supply chain. They're looking out in terms of their inventory levels, their shipping levels, their costs. It's going up. And they know that it's going up, and they're going to try to push that down to the consumer, and they're going to prepare you for it and try to find ways to at least protect or minimize the damage to their margin by passing through as much as they can. So then when I look at the underlying and you look at the trim mean CPI, so this is looking at 16% trim mean consumer price index. So this is trying to get closer to the pin. So these indicators point to, again, broad price gains. So this is looking at a month over month level, looking at those the price increases, and you're just looking at the percentages continuing to drive higher, and how much of this is transitory. And that's why when you look at the supply chain, you can say, sure, it's transitory. The supply chain will catch up with itself. It will. People are buying it. You can't, but at what price and how long will it take? And that's always the question of what is transitory. And is it, when you look at just, we're in May 19th now, and the supply chain has gotten worse, not better. Inventories have gotten worse, not better. So when is, like, we've been in this period now for over essentially over a year now. When is it going to get better? Like, at what point is it just no longer transitory and it's just going to be a factor of everyday life, because we have exported inflation for 20 some odd years to the lowest bidder, and now supply chains are shifting, and at time deliveries aren't working, and low inventory levels aren't working, which is again leading to the overhangs, which is where we look at the U.S. import price. So import price end use month over month was up 0.7. When we look at export price by export price, it was up 0.8. Then when you look at the year over year, we're up 10.6. When we look at export year over year, we're up 14.4. So on a month over month level, we're seeing more import prices increasing. And then year over year, we're obviously going to the moon. So these are the things that we continue to see, that we bought them now, so they were now imported. So those import prices, these things that are still in the supply chain, have yet to get past to the consumer, keeping this flow of increasing, or at least the drive to keep trying to capture more of your rising cost, is going to keep those consumer prices moving higher. And this is the one of the charts, if you want to say the chart of the day, the inflation spreads beyond base effect, because I think it's important to look at base effect here and look at the 3 months. The last 3 months does not capture the base effect. You're just looking at what has happened over the last 3 months, and you can see the acceleration in inflation. So when you go over the last 12 months, you're at 3%. Last 6 months, you're at 3.3%. But the last 3 months, you're at 5.6% inflation spreads. So it goes well beyond base effect, which is why, yes, is base effect real? Sure. But the month over month increases are not slowing down and continue to clip at a positive rate, which is just adding more and more cost that will be recovered. So then when you look at the consumer price index surprises versus consensus, this is just looking at the surprises continue to increase, and they're increasing in size. You're not getting a surprise in a positive way. You're getting a surprise to the negative way, and then that's why when the market acts like it's all priced in, you're like, okay, well, can that be priced in if you were expecting something that was going to be a bit more in your favor? So then when you look at it of volatility, well, it was a pandemic that brought the rolling standard deviation and core CPI percentage change over. And this is when we start looking at 12 months, 24 months, 36 months. We're starting to get this volatility again, because how much of this increase has been passed through? How much was it, moved along? There's a timing delay, which again, these are the types of things while we're going to continue to see more and more volatility. And what does volatility do to the consumer? It makes them cautious. It makes them pull back if they're not sure what they're spending on, if they're not sure what prices will be going forward. And then it'll also limit the amount companies will invest or CapEx, because if you don't know what your prices are going to be, especially if you're building something new, are you willing to do it given the uncertainties in the market? Now, the real household spending and disposable income. So real household spending has increased when we look at real household disposable income has started to come down a bit. So this is that mismatch where you had some of that pull forward, you had some of that stimulus money. Now the stimulus money is slowing down a bit. And you're getting some of these transfer adjustments, which is, again, things that are going to limit some of the consumer activities when you look at that real disposable income starting to come down a bit, starting to slow. And then as you have some of the adjustments to benefits, that's going to take a little bit more out, which, again, is going to decrease or at least put pressure on household spending. Which is why when we look at the consumer price index for all urban consumers, this is when we're looking at used cars and trucks. So you can see this huge surge because of shortfalls. Now, you might think, all right, well, it's going to be one time, and this will fade. This will absolutely fade. But let's look at the amount of cars in production, and you're seeing a fairly big decline again, where throughout May and actually early June, you have several companies that will shut down assembly lines to try to catch up in terms of steel, the leathers and plastics, and most importantly, chips and semiconductors, because this is where you're seeing these pitfalls. So these prices, not to say they're going to continue going higher, but they're going to stay fairly sticky, just given there is a shortfall in the market on the amount of inventory at the used car truck level. New cars are slow to come to market because of the supply chain issues. So again, this is not just something that will correct itself in a month or 2 months or even a quarter, especially when we look over the last few years. This could be a multi-quarter issue, which again leads to the point of what is transitory. So then when we look at reopening categories, what did they dominate? So used cars, rental cars, lodging, airfare, food away from home. All of those prices have gone up, and they're trying to pass things through. So even as we reopen, and it's another push behind additional price increases and additional movements, which is why when you look at all other components, there's that nagging bid behind it that is just going to keep things elevated, which is when we break it down a little bit further. Of course, CPI inflation decomposition, you can see that used cars was that big part of it, but you had the other pieces in terms of airlines, lodging. And as we go into summer, what is summer? Summer's more traveling. This is not a reopening statement. This is just people travel more in the summer, so prices go up. So, and the question is now, how much prices are going to go up? If you have, small hotels, bed and breakfasts that have gone bankrupt or have just closed in general, or maybe you have a hotel that is going to keep occupancy at 70% instead of 100% to limit the cost. All of these things are just going to drive up prices. So then when we look at core CPI inflation, this is when you look at that chip shortage related components and COVID sensitive services. But the chip side, again, that's the one that we still struggle to see how quickly we can close that gap. And in segment 5, we're going to look at some of those headwinds that are going to persist going forward. Then when we look at the adjusted retail and food service sales total, so the first time in history, going back to 1992, retail sales exceeded inventories as of April. So just think about the amount of inventory that's going to have to be picked up, again, at what cost? So then when we look at CPI, housing costs swing sharply higher. So as you get used car prices coming down, Well, what are home prices going to do? And that's when we continue to see this pull higher in rent and primary rents that are going to continue to be a driving force behind that CPI number, behind the inflation to the consumer. Because yes, you'll have used car prices and some of those other prices normalize, but this is just getting started. And this is just, I thought, a very good infographic in terms of what $50,000 worth of lumber can build you. So in 2021, May 5th, you could build 2 1/10 single family homes. In 2020, May 4th, you could buy 10, you could build 10 1/20 single family units. So just to think about the pricing, so that was $343 versus $1,635 looking at the lot size. So again, this is why we're seeing some of these slowdowns, which is when we look at the producer price index for inputs to construction industries are at 12-month highs, which is why we expect to see some of that slowdown in construction, manufacturing, as you again. But then you're on the other side, you're short inventories. These are the different conundrums that we live in that, again, is going to just maintain some of these prices. So then when we look at U.S. new privately owned housing units and private housing authorized by building permits, so the private housing authorized by building permits remains elevated, but new privately owned housing units started have fallen. So April housing starts were much weaker than expected at negative 9.5% versus an estimate of negative 2%. But building permits were also weaker than expected at plus 0.3% versus plus 6%. So on the ground, local home builder commentary. So when we think about what the home builders are saying, from across the country per an April survey, a lot of builders are pressing the pause button and or slowing things down until construction costs moderate and they can catch up with sales. Worries about buyers' price ceilings too. So they're concerned that buyers are starting to get priced out of the market, which again is going to limit the amount that you can charge and again pulling some of this down, which is why we're going to see some of this slowdown in just the economic recovery, which I think is something that isn't truly appreciated or factored into expectations when we're looking at not just the U.S., but also the global economic recovery. And that's why when, thinking about, okay, well, the home builders are saying it, but the consumers are saying it as well. University of Michigan buying conditions for homes have fallen to the lowest since 2002. And U.S. Michigan buying condition for houses related to price is, again, the lowest ever, or at least the lowest to 2002. These are the things that are giving people pause, which is why I think you're going to start to see a little bit of a cool down in that housing market. But when we look at U.S. housing activity, this is the same thing where single-family homes have stayed fairly flattish, multifamily homes elevated, and then total permits. So supply shortages and high input prices are headwinds, but demand and low inventory are tailwinds. So it's a matter of that push me, pull me of what's going to win out over time. And this is the housing side, gasoline, the pricing at the pump, pricing at the grocery store is leading people, again, consumer sentiment moving down, consumer expectations, present conditions are all deteriorating a bit as concern bleeds into the market, which is when we start looking at this putting it into context on the consumer sentiment index moving lower and expected change in prices during the next 5 to 10 years are going back to highs. So more economic data weakness. So sentiment much worse than expectations, fell to 82.8 in May versus an estimate of 90. And previous was 88.3. Current conditions at 90.8 versus 97.2 prior. Expectations at 77.6 versus an 82.7 prior. 5 to 10 year inflation expectations rose to the highest since 2011. Again, these are the things that are going to give people pause, especially if they're expecting a higher inflation rate. So then when we look at online shopping, it's interesting because, how things are shifting as you look at the consumer retail. Online shopping, sales in general as a percentage is going up because people feel better buying bigger ticket items while the share has come down because again, the thing that we said was that you're going to get a big spike in online shopping, and then it was going to come down. It was just going to stay elevated because we're going to reach a new normal. And that's where I think you're starting to see that here, where we're starting to flatline. And at this point, the percentage of retail sales is going to remain elevated at this, just looking at this chart, at about 15%, in general, as we go through the remainder of not just the year, but, realistically throughout the rest of our lifetimes in terms of the way people are shopping. With that being said, you had the downside surprise where U.S. retail sales were flat in April, missing an estimate of 1%. And that's where, when you look at the third round, this is the third round. So you had the third round of stimulus, which increased or pulled forward the retail sales. And now you're seeing them miss estimates by a wide margin, and those slowdowns in general, because when you look in overall, the first round of stimulus checks came through. You had a big spike in spending. Now you had people essentially preempting the new round, where the third round came through and people spent the money before they even had it. And then you get that drop down. So again, these are the things that I think are going to weigh over time. And this is just giving you the backdrop of where. So core retail sales were actually down almost 2%, even though total retail sales were flat. The core, I think, is the bigger issue and the bigger concern as we look forward as to where is that consumer growth going to be. And then when we look at, again, retail sales, less autos and gas stations, the survey was for positive 0.3%, came in at negative 0.8%. Retail sales control group was supposed to be at negative 0.2%, came in at negative 0.15%. The gas stations one is going to be an important one to watch to see how are people reacting to higher prices, additional pressures in the system in general. So then when you look at U.S. industrial production, April industrial production rose slightly less than expected at 0.7% month on month versus 0.9 estimate. And again, prior month was 2.4%. So you're starting to see some of this slowdown that you're seeing in terms of the peaking in general when we're looking at some of the activity where we're not back to pre-COVID levels, and the pace of that recovery is really starting to slow down, which again is going to weigh on labor, which is going to weigh on wages, which is going to weigh on wage increases. And again, you can see how this continues to be that overall pressure point. And this is, again, looking at 2018, 2019, we're still well below those levels. Though when you look at U.S. core CPI index, you're starting to get above the trend line. But this is you looking at U.S. core, because then when you turn to U.S. is still catching up in general on the level of consumer price index on the based on what the path is, and this is where things get a little bit soft, and this is what people look at when they try to say that inflation isn't that bad yet, because when you look at the pre-pandemic Federal Reserve target path, the idea is that there's more room to make up. I would be on the other side of that, but again, this is just another side to the argument, saying that there is more room in general. So now in the next segment, we're going to turn to Europe a bit and go through some of these adjustments that have happened in just some of the data points. It was a little quiet there, so that segment will be a bit shorter.